Well, with that, ladies and gentlemen, humble apologies for our panelists who were there on stage. We're going to be continuing with that conversation. We were keenly looking forward to your inputs on the same. We're extremely elated that we have with us our guest of honor, Shri Ananth Narayan ji, whole-time member, SEBI, who has taken out his valuable time and joined us again. Shri Narayan ji, I remember last time when you were a part of one of the forums at N-Cube Collaborations. It was great to hear her. All the endeavors of N-Cube Collaborations. So Shri Ananth, currently a whole-time member of Securities and Exchange Board of India, which is SEBI, looking after the Market Regulation Department, Alternative Investment Fund and Foreign Portfolio Investor Department, Enforcement, Inquiries and Adjudication Department, the Office of Investor Assistance and Education, and of course the Department of Economic and Policy Analysis. Shri Ananth has also served on several RBI and SEBI committees and working groups. For all the leaders in the room, a lot of us have followed what Shri Ananth ji has done to the entire community. And as Dr. Narendra rightly said, he's been actively with the N-Cube collaborations in these prominent events. And it's indeed an honor for him to, for us to have him join us on this forum and take out his valuable time. So, extremely busy, cutting all ends and joining us on the same. So let's give him a warm round of applause as we welcome Shri Ananth Narayan ji.
No, I don't have a presentation. Actually, can I use the mic as well? Good morning, everybody, and sincere apologies for being late, and sincere apologies for putting the next panel into inconvenience. I really don't have an excuse other than Mumbai traffic is very unpredictable, and unfortunately BKC to here, while as the crow flies is very close, coming by a car can be a little tricky. So thank you again for having me, Dr. Narendra. You know, he mentioned that, and the host also mentioned that I've been associated with N-Cube for a long time. The reality is I can never say no to Dr. Narendra. He has done so much for the ecosystem and continues to do so. And I really appreciate all the good work that you're doing. What I thought I'll do today is talk a little bit about the SEBI perspective to capital formation. Our job as SEBI is to ensure that there is continued capital formation happening in the economy. While people see us as a notorious regulator, always chasing people and telling people what to do, what not to do, actually if you see our SEBI Act, the preamble itself starts with 3 pillars which defines SEBI's role. The first is investor protection, the second is market development, and the third is market regulation. You put the 3 together, and our job is to ensure there is sustained capital formation in the country. If we over-regulate and we don't let people create capital, we are not doing our job. So we are completely conscious of our role. What I thought I'll do today is trace a few numbers and look at how capital formation has progressed in the country over the last few years. Then I thought I'll talk about some of the challenges that we face as a regulator in ensuring that sustained capital formation ensues. And there are lots of choices that we have to make when we come out with our regulations, etc. And third, I wanted to look a little bit into the future as to how things could pan out and what we should be doing collectively as an ecosystem for capital formation. So let me start with the trends that we have seen in the recent times. I think it's been remarkable over the last, in fact, over the last 30 years, ever since SEBI has come into being. It's now 36 years since SEBI came into being. But particularly in the last few years, it's been a remarkable journey. I think one key trend that we have seen, particularly since COVID, is that the number of savers willing to put their hard-earned money into India's capital markets has grown up dramatically. And now, we're also seeing issuers coming in willing to raise that risk capital to create businesses, to create new enterprises, to create new jobs, new savings opportunities, and so on and so forth. This is the crux of capital formation. After all, what is capital formation? People should come in with their money, willing to take on risk. That money should be tapped by risk takers, entrepreneurs, companies, and so on and so forth, to create businesses, which in turn creates jobs, wealth, and so on and so forth, which again comes back into the capital markets. You want a virtuous cycle where investors and capital raisers are feeding into each other. So if you look at what's been happening over the last few years, the big trend has been the rise of the domestic Indian investor. Between fiscal year 15 and fiscal year 20, so around 6 years, on average, give or take, we were seeing about 1.4 lakh crores worth of fresh money come into risk-seeking, mutual fund schemes. So outside of fixed income, look at equity, look at balanced, remove arbitrage, look at ETFs, look at index funds. So essentially your money, my money, everybody's money coming in seeking risk into mutual funds used to average about 1.4 lakh crores per year. FY21 was a bad year. That was COVID, where everybody was going through, asking a lot of questions. Subsequently, FY22 to FY24, 3 years, that number jumped up from 1.4 lakh crores on average to 3.2 lakh crores on average, more than double. So particularly after COVID, all of us seem to be willing to take on a lot more of risk and put in money into the capital markets. It doesn't stop there. We are currently in FY25. So for the 9 months from April to December 2024, which is the 9 months of FY25, the total domestic money coming into domestic mutual funds seeking risk, remember it was about 3.2 lakh crores average previous 3 years, has already hit 4.8 lakh crores. This is a record of all time. We've not seen flows like this coming into our mutual funds seeking risk. Remember, this is not fixed income money. This is not liquid funds. This is money coming into equity-oriented, balanced schemes, hybrid schemes, and into ETFs and index funds. One of the issues that this is as far as the money coming into the system is concerned, and without even counting things like insurance money, pension funds, individuals bringing money. I'm only speaking about mutual funds. Remember, this is one part of the equation. You also need to have people raising money, right? And you need fresh issuance of paper, right? So if you look at the number of how much money was being raised by companies between FY22 and FY24, remember that time 3.2 lakh crores was the money coming in into mutual funds. On average, fresh issuance of paper, which is IPO, FPO, QIBs, rights issues, and so on and so forth, not offer for sale, not the promoter selling a stake, but the company itself issuing fresh paper and raising money for it to deploy, averaged about 1.5 lakh crore per year. So 3.2 coming in into mutual funds, fresh issuance of paper was 1.5 lakh crore per year. One of the worries that I have personally spoken about is there is a mismatch. There is a lot of demand for paper and not enough of supply of paper, right? That is not good for capital formation, because if there is more demand than supply, you have price going up. You don't really know whether the price going up is justified or not. Then people start talking about valuations. And it's not great for capital formation, because simply money pouring into secondary markets is not capital formation by itself. Ultimately, capital formation requires money should be tapped by risk takers to create businesses. So I've often worried about this demand-supply mismatch. I'm very happy to report FY25, which is the current year in progress, we've seen record level of IPOs of fresh issuances of paper as well. So compared to 1.5 lakh crore on average between FY22 and 24, the amount that's been raised in terms of fresh capital being issued by companies already is 2.9 lakh crore between April and December, almost doubled. Again, this is a number which is an all-time record. We've never seen this kind of issuances. So both in terms of demand for paper and supply of paper, the numbers have gone up dramatically. The gap between the demand and supply has narrowed. This is a fantastic, outcome for the capital markets ecosystem. So while we talk about, oh my God, this is a problem, that is a problem, regulations, some other issues, etc., 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 the reality is this ecosystem, which is all of you in the capital markets, is doing a fantastic job. So whether it is mutual funds, whether it is intermediaries, whether it is exchanges, clearing corporations, depositories, whether it is issuers, whether it is investors, all of us, we deserve a pat on the back for the last few years. Now that's the good news. Now let's come to the next part. Despite all this good news, there is absolutely no room for complacency. Because we have a long way to go. We are still a poor nation. We still have a long way to go on capital formation. Both opportunities and challenges abound. Opportunities because if you see the number of investors who invest into capital markets, who come under the SEBI ecosystem, so I'm not talking insurance, I'm not talking pension funds, I'm not talking anybody else. I'm only talking, mutual funds, AIFs, and so on and so forth. All of these put together, there were about 4.4 crore unique individuals under the SEBI umbrella in capital markets as of March 2020. Today, that number of unique number of investors through mutual funds, through direct investments, through DMAT, through AIFs, through PMS, through all of this, has crossed 13 crores. So it's almost tripled in terms of the size since March 2020. But the number of people who have their PAN numbers linked to Aadhaar, unique number, is over 60 crores. So while we celebrate 13 crores, and we celebrate the fact that we have almost tripled in the last 5 years, we still have a long way to go. So you've seen our consultation paper on saying 250 rupees SIPs for mutual funds. It's one step, this tokenization, to try and see if we can get more and more people into the capital markets ecosystem in a safe manner, right? So the opportunities are immense. We cannot rest on our laurels and say we have done a great job. The second, in terms of challenges, see, our entire ecosystem relies on trust, even more than the banking system. So you need investors to come in trusting the ecosystem. You need investors to be risk aware. Financial inclusion in the RBI, the banking world, is relatively simple. Just get people to open a banking account. In our world, it is not as simple as open a DMAT account or open a mutual fund account. You should open with your eyes open. You should open these accounts knowing that there is risk in the ecosystem. Mutual fund sahi hai, but mutual funds are also subject to market risk. Please be aware. Don't come in glassy-eyed with stars in the eyes thinking you'll become millionaires overnight. Aisa nahi hota hai. There is a lot of risk in the ecosystem. So the need to ensure trust and risk awareness in the ecosystem is of paramount importance. If we push too hard and say, sabko leke aao andar, we risk killing the goose that's laying the golden eggs. We cannot afford that. So what can, question the trust in the ecosystem that we have to be aware of and we have to be very conscious about? If there are governance failures, if there are frauds, if there are manipulations, if there are technology hiccups and challenges and frauds that happen, all of that can cause the trust in the ecosystem to come down. And we have to guard zealously against it. So all these things that I mentioned to you, when wrong things happen, when a fraud happens, when a governance issue comes up, when a manipulation happens, when a technology failure happens, these are all what I like to call type 1 errors. When bad things happen, that's a type 1 error. Every regulator spends sleepless nights having nightmares about the possible type 1 errors that can come up tomorrow. For instance, while we celebrate digitization, imagine the situation if all of our data in the depositories, there was to be an attack, and the data is available in the dark web for a price. Can you imagine the consequences in terms of privacy, in terms of trust, in terms of the entire integrity in the ecosystem? These are real risks that we have to worry about all the time. So preventing type 1 error is a crucial job of regulators, and not just regulators. I would argue it's a crucial job of the entire ecosystem. It is too big a job to be left to the regulator alone. All of us have a role to play in ensuring that these type 1 errors are taken care of. Excuse me. On the flip side, we are equally conscious that if we tilt too much towards only preventing type 1 errors and worry all about preventing type 1 errors, the easiest way to prevent type 1 errors, market hi band kar do. Na rahega baas, na bajegi basuri. So, if in our zeal to prevent type 1 errors, we come up with a regulatory ecosystem that is so difficult that even good people can't do business, can't raise capital, that is a type 2 error, where regulations come in the way of good capital formation. Now, those of you who are mathematics graduates, etc., know that type 1 errors, type 2 errors are an intrinsic part of statistics, right? Now, if you remember your statistics, it is impossible to minimize type 1 errors and type 2 errors simultaneously. It's not possible. You have to do an optimization where you try and get a mix and match. However, in regulations, I put it to you that it is possible to minimize both type 1 and type 2 errors simultaneously. If we speak to each other, not past each other, if we are trusted advisors to each other, if you explain to the regulator what is happening, if we explain to you what we are thinking, and then we arrive at the appropriate regulatory mix. I want to give you a couple of examples of where we have tried to use this approach of trying to balance between type 1 and type 2 errors. First example I want to give is on the FPI regime, the Foreign Portfolio Investments regime. So FPIs, earlier known as FIIs, have been there since the 90s, ever since we opened up our markets to foreign flows. Ever since FPIs have come about, we have always sometimes had to worry about the identity of the people behind the FPIs. Is it a local promoter who is routing the money outside and bringing it back? Is it some unknown foreigner who is trying to take a large stake in a domestic company? So the question of who is the person who is actually behind that FPI periodically comes. It's not a new thing. We've had these questions coming up for the last 30 plus years, ever since FIIs came in, ever since P notes were there. Now they're called overseas derivative instruments. So this question of identity was always there. And by the way, if it was actually domestic money coming back in defiance or in contravention of our requirements of minimum public shareholding, if there was money coming in defiance of the substantial acquisition of shares and takeovers rules, that would be a type 1 error. So how do you prevent this type 1 error has been a question that has dogged regulators for many years now, for decades. It's not a recent phenomenon. And we've struggled with how to do this. Now, one way to do this would be to insist that every FPI has to give us every detail down to the last cent. You tell us who the investors are, who your managers are, who is the person in control, who are the owners of the fund. Tell us everything to the last cent. Now we have 11,600 FPIs in the country who have invested in the country. I can tell you, if we came with a rule like this, all of you give me all full details, a majority of them will not be able to comply. And that doesn't mean they're illegitimate. That doesn't mean they're illegal. It's simply the way many funds are structured globally that they will simply not have visibility to the last mile of every single investor. Those of you who have dealt in foreign markets would know this. So if we came with a regulation requiring that you should disclose every single entity behind your fund to the last cent, we would address our type 1 error, but at a huge cost of a type 2 error. Right? So how do you address this? We actually have tried to address this in 2023. So what we did was the following. We said, let's use a risk-based approach. We will not paint everybody with one brush. Let's take a risk-based approach. Let's start with FPIs that have invested more than 50% of their equity assets under management into one corporate group. If you have concentrated positions, then I want to know more. Only then. If you have a diversified position across 20 corporates, no problem. But if you have a lot of concentrated position in one corporate, I'm going to ask you a lot of questions. Even there, if you're a sovereign wealth fund, if you are a mutual fund registered in the US or Europe or elsewhere, which is regulated by an entity there and to ensure there is lots of checks and balances. If you're an insurance company investing your own funds, if you're a public pension fund, if it is possible to trust but verify, we will verify that you are indeed a regulated entity which is subject to regulations. If we can verify all that, we will not ask you questions. The people who cannot provide this, so who have a concentration problem, who are not exempt because they are not a public retail fund, they are not an insurance company fund, they are not a sovereign wealth fund, etc., then I want to know everybody behind you, without exception, to the last cent. And if you tell us, sorry, I'm based in British Virgin Islands or in some island nation where I cannot give you the details because I have secrecy laws, then we will say thank you, but no thank you, please leave the country. So we went down that path. We implemented this by way of an August 24, 2023 circular. Because of the circular, by 31st of Jan, you had time to adjust your positions to bring down your concentration below 50%. If you could not do this adjustment and you were still breaching this 50% threshold, then by 12th of March, you would have to give us all details. If you could not give us all details by 12th of March, you had to exit by 9th of September 2024 to avoid heavy penalties. People have left. There are funds that have had to leave. How is this done in terms of type 1 and type 2 errors? Now, I want to remind you something. By the way, outflows happened. Outflows did happen till 9th of September 2024. But the beauty is, if you look at the FPI flows between Jan 2024 and September 2024, they were a huge net positive. So nobody even realized that some amount of money was going out. Every FPI which had to leave, we were looking at them very closely. If we saw some reason to believe this could be a type 2 error, where we were asking a good guy to go, we would have a dialogue. So we were very, very careful about ensuring that we were not penalizing bad people, good people. And only where we had doubts, we said, you can please go. Now, some people have speculated that, in October onwards, we saw some FPI outflows. They said, oh, it's because of the circular. That is utter rubbish, because that circular came into effect and was over by September 9th. Thereafter, you had to pay a very heavy penalty if you had to exit. So in fact, almost everybody exited by 9th of whoever had to exit. And the numbers were manageable. We were very, very careful. So it was an approach where we did not paint everybody with one brush. We took a very, very risk-based approach, making sure that we were very, very clinical, surgical in doing what we were doing. We did not want to impact the entire market. I'm not saying it was perfect, but I'll tell you what are the good things in this approach. We did not do everything ourselves. If you left it to SEBI sitting in our ivory towers, we don't understand business. We don't understand what happens on the ground. We would probably come up with regulations which are either too lax or too tight. But what we did was, and that's a feature of the way SEBI operates, there was immense amount of consultation with all manners of stakeholders. Whether it is custodians, whether it is designated depository participants, whether it's with the exchanges, depositories, and clearing corporations, whether it's with the FPIs, whether it is with other investors, mutual funds, etc., who understand this ecosystem. There were plenty of discussions. And these rules, by the way, all the rules that I explained about exemptions and concentration limit, etc., it's a 90-page document. It's an SOP, a standard operating procedure, which has been put together into detail. How do you know which entity to exempt? It has to be objective. It can't be based on what I had for breakfast in the morning. It has to be an objective, trust but verify principle to exempt somebody from more disclosures. It's a standard SOP that every custodian in the country uses. And it's been put together by the custodians themselves. We told them, this is our regulatory intent. Now you tell us how you will put this into effect. And of course, they had to do it in consultation with us. We had to be convinced that this works. But they came up with something which hopefully minimizes both type 1 and type 2 errors. So the point is, the earlier point I made, that it is possible to minimize both type 1 and type 2 errors if we have an open dialogue where industry collaborates with regulators, regulators listen to the industry, and then we come up with something which matches our overall regulatory objective. So I wanted to compliment the ecosystem which helped us come up with this solution which minimized both the errors. I want to give one more last example before I move on. This is on futures and options. Again, a favorite topic of discussion across multiple people. Derivative markets in India in equity derivatives are extremely vibrant. They're very, very active, and they are practically always the topic of discussion nowadays, right? We saw some, now let me be very, very clear about our objectives vis-a-vis derivative markets. Let there be no doubt. As a regulator, we believe we need derivative markets because derivative markets aid in price discovery, they give you market depth, and they give investors the avenue to hedge or take on risk. We need markets, we need trading, we need speculators. Without all of this, capital formation on a sustained basis cannot happen. So we don't mind derivative markets, but there were a couple of issues that came up that bothered us vis-a-vis derivative markets. The first, in January 2023, if you recollect, we came out with a report which showed that 89% of all individual traders in F&O markets in India were losing money. I'll repeat that, 89% of all individuals are losing money. Thereafter, we updated this research around August, September of last year. And we found that for the last 3 years, last 3 fiscal years, 93% of small individuals trading in this market were losing money. On average, about 1.5 lakh rupees over the last 3 years. It doesn't stop there. People who had lost for 2 years in a row in derivative markets, by a majority, continued to trade in the 3rd year as well. It was almost becoming a national pastime and a national addiction. It doesn't matter if I'm losing, I still want to go back there, right? So this is the first issue. And as I mentioned to you in the beginning, our primary responsibility is investor protection. We can't close our eyes to it. We are also aware, in fact, one of the maxims in my room is first rule, do no harm. It's part of the Hippocratic Oath. As doctors, you might have the best of intent, but in your best of intent, don't deliver medicine or remedies which makes the patient worse than he or she was before. So in the case of regulations as well, we have to be very careful that with the best of intent, we should not interfere to actually disturb capital formation in the country. So initially, our approach was to tell the investor to disclose to the investor what the risks are, and then let the investor take a call. So anybody who's traded in derivative markets, when you log in into a broking account, you get that irritating pop-up saying 9 out of 10 individuals lose money in derivative market. It's like that statutory warning on a cigarette packet. You click on it and then you trade. Your hard-earned money, you do what you have to do, but be aware of the risks. That was the approach that we took until a long time. The second risk, which is less spoken about, the amount of market risk that was aggregating in the ecosystem on every day, particularly on expiry days, was incredibly high. Particularly on expiry days on some key indices, till 3:15 p.m. in the evening, in the afternoon, just before markets closed, the risk in the system as a whole, accumulated risk, open interest as we call it, was actually rising. So God forbid, if at 3:20 on an expiry day, you had a global 9/11 kind of an event, while we have a lot of good checks and balances on margins, etc., we had no idea what would happen to the ecosystem in terms of actual possibility of a risk kind of blowout. So both these issues, investor protection as well as accumulating market risk, especially on expiry days, was a problem. Now remember, the point was about how do you balance between type 1 and type 2 errors. The easiest thing for us to do would have been to say close derivative markets. But as I said, that's not our intent. Derivative markets are important for capital formation in the country. So instead, we again discussed a lot with market participants, and we clinically identified what was the biggest issue. The biggest issue was over-trading in index options on expiry day. It was not single stocks, futures, and options. It was not futures on indices. It was not options on indices outside of expiry day. Bulk of the problem was options, index options trading on expiry day. That's where all the spurious, casino type volumes are going through. That's where all the risks were building up. That's where all the individual losses were accumulating. So on October 1st, after a lot of consultation, in fact, we had 15,000 plus responses that came on our consultation. We had to go through all of them. We finally took a series of 6 steps on October 1st. Most of them were focused purely on controlling over-trading in index options on expiry day. In fact, alongside these steps, we also increased the number of stocks on which single stocks, futures, and options operate. We also gave some other relaxations in terms of futures and other trading. So people would ask us, have you gone mad? On one hand, you're closing, and the other hand, you're opening. Kya kar rahe ho tum log? It was very clear. We had identified the issue very clinically as one particular issue. We were focusing on that. We had no problem with the rest of the ecosystem. Now, the steps are still taking effect. We will see how this plays out. We will watch the data very carefully. We will be in consultation with the market participants. If we need to take more steps to control or more steps to relax, we will do whatever is required. But again, the approach has been as thoughtful as possible to try and localize the issue, ensure type 1 errors are addressed without creating type 2 errors. And it's an ongoing process. I'm not saying the work on F&O is done. There is still work going on. In fact, one of the things we realized is the way in which we measure risk in F&O is wrong. And therefore, we will come out with a consultation on changing that. There are some fears of manipulation happening in between the cash market and the derivative markets. We will take steps to address that. And by the way, I want to tell you this. Our surveillance ecosystem, whether it's the exchanges or at the SEBI, they're very good. I'm not saying manipulation doesn't happen. I'm not saying fraud doesn't happen. In fact, recent orders show front running does happen. You do have bad things happening in the market. But we eventually get it. The market might be 2 steps ahead of us, but we are close on the heels. We'll figure it out. So anybody doing manipulation is doing at their own risk. We will find them. So building the trust in the ecosystem remains a key part of our mandate on the futures and options as well. And we will take a series of steps to improve the risk metrics and improve the trust in the futures and options ecosystem. Separately, we will continue to watch what's happening on systemic stability as well as on investor protection. So these were two examples I wanted to give, essentially to make the point that we, at least as regulators, do worry about both type 1 errors and type 2 errors. We are not concentrating only on one type of error. We are genuinely trying to minimize both. And I can promise you as an ecosystem that whatever we do is done thoughtfully, along with a lot of consultation with market participants, with all stakeholders who are experts. We try and get as much knowledge as we can to get this mix right. And why are we doing this? Come back to the original point. We are about capital formation. We are not about closing down businesses or letting them lose. We are about making sure trust in the ecosystem remains. Unless we get this right on reducing both type 1 and type 2 errors, that trust is at risk, particularly when we want to grow the ecosystem. My last bit is, what are my asks from the ecosystem? My sincere request to all stakeholders, please become trusted advisors to us. You know, what bothers us a lot? For instance, there are industry groups representing different parts of the industry which come to us and say, oh my God, your regulations are terrible. They might be right. I'm not saying they're not right. But this is a problem, that is a problem, reduce this regulation, remove that regulation. So my problem is twofold. If you only talk about type 2 errors, where regulations you say are coming in the way of business, without talking about type 1 errors, we will not trust you. AIF industry, and I have to compliment that ecosystem of alternate investment funds. I think they've done a lot of good things in the last 1 year, 1.5 years. 2 years ago, we saw the AIF industry being misused to structure to circumvent existing financial sector regulations. There were not 1 or 2 cases, there were several cases. And we did not have too many people from the industry coming and telling us, by the way, there is this malpractice happening, you should take a look at it. We found out the hard way through investigations, through other intelligence sources coming to us. And then sometimes we went back to the industry and told them, is it true that these egregious wrongdoing is happening, where there is circumvention of RBI regulations, of FEMA regulations, of NCLT and IBBI regulations? Is this really happening? And in one-on-one conversations, the industry folks would tell us, yeah, of course it happens. ये नहीं और भी ज़्यादा होता है. अरे तो पहले क्यों नहीं बताया? Why do you have to wait for us to ask you what's going wrong? How do you expect us to trust you if you're not forthcoming on what the type 1 errors are? You know far better than we do. We will know the last. As we are fond of saying in SEBI, we are like the Bollywood policeman who comes in the last scene after the climax, when everything is over. We'll be the last to find out. You tell us beforehand. So first request is, when you see something, please say something. This is not snitching on people. This is not chugli karna. This is simply preserving the trust in the ecosystem. Anytime you see something going wrong, some jugadu thing happening, you are risking the trust in the ecosystem. It's not worth it. Please come and talk to us about it. And when you do that, our trust in you becomes that much more enhanced. So when you talk to us about over-regulation or type 2 errors, we'll be a far more open for discussions. Final point, when you come to us asking for, talking about type 2 errors and saying, ये regulation बहुत onerous है, इसको relax करो, we will listen. But it would really help if you think about, if I relax this, what was the intent behind coming out with this regulation? What was the type 1 error this was trying to address? If you think this is creating a type 2 error, what is a better way of addressing that original type 1 error? Think like us a little bit. Besides just asking for removal of regulations, tell us how can we address the risks better. So thinking a little bit like us would be really useful. So my ask to you is, and I promise you, we will reciprocate. Talk to us, don't talk past us. We will also talk to you, we will not talk past you. Please be trusted advisors. Talk to us and tell us what's happening. And once you build that trust in the ecosystem, we can try and reduce type 1 and type 2 errors together. That will make the way for sustained capital formation in the economy. I thank you for your time. Thank you again, Dr. Narendra, very much.
Thank you so much. Let's give Shri Ananth Narayan ji a warmer round of applause. What a fantastic address that was. And of course, always great to have him in all the editions of NCube collaboration. And it's truly an honor when you have the whole-time member SEBI talking about not just what lies ahead, but how collaborations within the various industry stakeholders can further the capital formation of our country. Some wise points coming from the leader, and of course we encourage such discussions forward. Thank you once again, Shri Ananth Narayan ji, for joining us.